Your Excellencies, esteemed governors, esteemed delegates, my name is Lubo Siois. I'm the host of the Dubai Talk Show and executive producer. I want to welcome you to the AAM Summit 2025. This year we have a very interesting agenda, mapping the future of global investment, the new wave of globalized investment landscape towards a new balanced structure. Today, at this session, we will focus to the head of stock, with the heads of stock exchange markets roundtable. Let me present you our moderator, Dr. Ghofrani, Irfan Ghofrani. Please go ahead with the session. And just to let you know, in the beginning, 6 to 7 minutes per person, just to make the opening remarks. And Irfan will let you know with the Q&A and the structure that will follow. Thank you.
So, welcome everyone, and thank you for joining us today at the Head of Stock Exchanges Markets Roundtable at AIM Congress. It's both a pleasure and honor to moderate this discussion with such a distinguished group of esteemed members. So our gathering brings together head of major stock exchanges and trade associations from across the globe to examine the evolving financial landscape in 2025. This is an invaluable opportunity to share insight on emerging trends, foster deeper collaboration, and address shared challenges and opportunities in increasing complex market environment. Together, we will explore innovative solutions to uphold market integrity, manage volatility, and drive sustainable growth, while also developing strategies to enhance stability, transparency, and investor confidence. Through this collaborative dialogue, we aim to pave the way for a more resilient and dynamic future for global financial markets. I'm very pleased to introduce distinguished members of today's roundtable. We are joined by the head of stock exchanges and trade associations from around the world, each bringing valuable expertise and leadership in shaping the future of global financial markets. I will now introduce the members in alphabetic order. Mr. Haitham Al-Salmi, Chief Executive Officer, or for in short, CEO of Muscat Stock Exchange. Ms. Maria Ariza, CEO of BIVA Mexico. Mr. Lucas Bonco, CEO of Bratislava Stock Exchange. Sorry for my mispronunciation. Mr. Hassan Dude, CEO of Somali Stock Exchange Markets. Ms. Nurban Fahmi, Chief Operating Officer and Legal Counsel at Maldives Stock Exchange. Ms. Ivana Gazik, President of the Management Board at Zagreb Stock Exchange. Mr. Fadi Kanso, Deputy Secretary General at Arab Federation of Capital Markets. Mr. Ruslan Khailov, CEO of Baku Stock Exchange. Mr. Petr Koplik, CEO of Prague Stock Exchange. Mr. Miguel Monteiro, Chairman and CEO of Cabo Verde Stock Exchange. Mr. Georgi Funcho, CEO of Royal Security Exchange of Bhutan. Mr. Ivan Shteriev, CEO of the Macedonian Stock Exchange. Mr. Jalil Tarif, Secretary General of Union of Arab Security Authorities. And Mr. Hai Kiganian, CEO and Chairman of Management Board at Armenia Stock Exchange. And I am Irfan Ghofrani, financial economist at the World Federation of Exchange and member of its research team. Very happy to be here. Very good. So here we have a short agenda of our discussion that we are going to have today. The roundtable is organized into 3 main sessions. Session 1, regulatory challenges and opportunity. Session 2, financial market integrity. And finally, session 3 will focus on sustainable finance and ESG integration. In each session, selected participants will present their insight on key topics by addressing specific questions. At the end of 3 sessions, there will be a Q&A session providing participants the opportunity to offer feedback and ask questions on the points and remarks shared throughout the session. This structure is designed to foster a dynamic exchange of ideas and encourage in-depth discussion of these critical issues. As we have a great number of the participants in roundtable, and unfortunately we have time constraint, it would be greatly appreciated if each participant could address their remarks in 5 to 6 minutes to ensure equal opportunity for all participants in the discussion points. Thank you very much. And finally, we are going to conclude with closing remarks, summarizing the key takeaways and highlighting the main points discussed throughout the session. Perfect. So let's start with the first session, which is regulatory challenges and opportunities. Is there any question about the structure of the agenda? No. Perfect. Great. So the session 1 will address several key questions related to the evolving regulatory landscape. We will discuss recent regulatory challenges faced by stock exchanges in various jurisdictions, examining how these challenges have impacted market operation and compliance efforts. The session will also explore the specific challenges and lessons encountered by frontier markets in their efforts to upgrade their markets. Additionally, we will examine the effect of the regulation on stock exchange operation and overall market stability. The session aims to provide insight into navigating regulatory hurdles and sharing valuable experience from different market environments. Perfect. So we will start with the first question that we have for this session, and that is, what recent regulatory challenges have stock exchanges in your jurisdiction faced, and how they have impacted market operation and compliance efforts? We would be more than happy to start with Ms. Nurban Fahmi, Chief Operator Officer and Legal Counsel at Maldives Stock Exchange.
Honorable Chair, fellow exchange leaders, and distinguished participants, it is a privilege to be a part of this timely roundtable under the banner of AIM Congress 2025, where we gather to reflect on shared experiences and chart a collective response to the evolving global investment landscape. As we explore the themes of market volatility, regulatory transformation, and sustainable growth, the Maldives Stock Exchange, though modest in scale, brings a unique perspective shaped by resilience, reform, and regional collaboration. The MSC continues to play a critical role in the Maldivian financial ecosystem, offering a regulated platform for securities trading across finance, infrastructure, and tourism, our largest yet underrepresented sector in the Maldives. As of 2025, our market includes 9 listed companies with a total market capitalization of approximately USD 2.1 billion. While we face liquidity constraints and limited investor breadth, we see opportunity in diversifying capital participation, particularly through reforming institutional investor mandates and strengthening SME pipelines. In recent years, we have focused on infrastructure transformation. The launch of Infinity, our automated trading platform, has enhanced market access and operational efficiency in our dispersed nation. In parallel, our private securities market, Vienna, has become a key platform for private debt issuances, addressing financing needs of firms not yet suited for public listing. Still, public equity listings have not grown. Our last occurred in 2019, underscoring the importance of removing regulatory and market entry hurdles for local enterprises in the Maldives. To encourage foreign investments, the 2024 amendment to our Securities Act empowered the Capital Market Development Authority to create a dedicated framework for portfolio and direct foreign investors. This reduces procedural barriers and strengthens investor protection. Moreover, in July 2024, the CMDA has signed a Memorandum of Understanding with the Securities Exchange Commission of Sri Lanka, enabling secondary listings on the Colombo Stock Exchange Multi-Currency Board. This step has opened new cross-border listing opportunities, and we believe it illustrates how bilateral collaboration can improve regional liquidity and investor reach. We hope to replicate such partnerships across jurisdictions represented here today as well. Foreign exchange controls introduced in the late 2024 in the Maldives, particularly those requiring the partial conversion of tourism revenues, have raised concerns across capital repatriation and predictability for investors. While capital market transactions remain exempt from these, the broader currency environment still affects the sentiments of market investors. In addition, the IMF's 2023 Financial System Stability Assessment highlighted gaps in structured coordination between our monetary and securities regulator. Although an MOU exists between MMA and the CMDA, operational cooperation remains rather limited. As volatility increases globally, we echo the call for deeper regulatory harmonization both domestically and internationally. Two significant regulatory developments in 2024 also merits mention here. The first amendments to the Dealers and Representatives Licensing Regulation, published in 2024, enhanced licensing standards and professional conduct requirements for brokers in our market. The new Principal Advisor Regulation, published in August 2024, defines expectations for entities advising issuers, ensuring competence, integrity, and accountability. These reforms reflect a strong move towards global best practices, but also introduce new compliance and operational demands on our companies. For smaller intermediaries, these shifts require adaptation, and we believe technical support and industry dialogue are vital during this transition. The Companies Act, effective in January 2024, this was a new published one by comparison to the previous one, modernized our corporate governance framework, mandating the appointment of company secretaries, beneficial ownership disclosures, and updated meeting procedures. These measures aim to create a more transparent and investor-friendly environment in the Maldivian investment sector. Complementing this, the Maldives Sustainability Reporting Framework, published by CMDA in October 2024, is a landmark development in our market. It outlines reporting requirements for listed companies and capital market licenses across 5 ESG themes, namely governance, environmental impact, social responsibility, workforce matters, and community contributions. Although reporting is currently on a voluntary basis, it will become mandatory for listed companies and licensees starting from 2026. CMDA has also issued guidance on materiality, stakeholder engagement, and metrics to support effective implementation. This phased approach is designed to ensure preparedness, but challenges remain in terms of internal capacity and data collection, especially for smaller issuers. We recognize that the success of ESG integration depends not just on policy, but on active support, industry training, and technological adoption. As we transition to mandatory disclosure, strengthening sustainability governance and frameworks at the company level is a top priority in the Maldives. As highlighted in today's agenda, cross-border listings, ESG adoption, and regulatory alignment are not just trends, they are shared imperatives across our countries. Our engagement with Sri Lanka offers a small but a meaningful example of how we can bridge smaller markets to broader ecosystems. In that spirit, we fully support AIM Congress 2025 mission to drive collaboration and welcome the development of policy recommendation papers arising from this roundtable. It is through these forums that we, as market leaders, can convert dialogue into practical strategy. Thank you for the opportunity to share the Maldives perspective. I look forward to continuing this exchange and contributing to the collective insights that will emerge from our discussions today. Thank you.
Thank you very much, Ms. Nurban. Very interesting discussion. So I would ask the same question from Mr. Hai Kiganian, CEO and Chairman of Management Board at Armenia Stock Exchange. What recent regulatory challenges have stock exchanges in your jurisdiction faced, and how they impacted market operation and compliance efforts?
Hi everyone, and thank you for organizing this event. It's quite important for the stock exchanges, especially because the way we learn and develop is through this intelligence exchange. And generally, we are coming from small countries, small exchanges, and bottom line, we have the aim to bring foreign investors into your market. And for everyone, the major challenge is the lack of investable opportunities in your local market that the foreign investors can actually invest. So that's why we usually start with the government bonds. So unlike standard stock exchanges, we are more a fixed income house, and we have started to develop the bond market. So we are running the government bond auctions, corporate bond auctions, secondary market. We have very limited number of equities traded in the stock exchange. But to follow our long-term aim, we have sold our major share to Warsaw Stock Exchange. So we are now Warsaw Stock Exchange owned company with the aim of integrating with the European capital markets so that we can enable the European investors to trade in your exchange and to have access to your exchange, hence to have access to the whole economy of Armenia. So the major challenges then start to rise. There are regulatory equivalence in order for the institutional investors to invest into your jurisdiction, which is outside of EU or OECD. Your jurisdiction should be considered as equivalent to their own jurisdictions, which means that the regulators should sign equivalency MOUs with every single jurisdiction that you want to bring money from. So this is number one. Number two is the existing regulation. For example, now we have triggered a change of law which should enable remote membership. The third challenge is the clearing house. If you don't have access to the international clearing house, it's very difficult for the international investors to trade on your exchange because you cannot enforce them to open an account in your CSD. Hence, you need to have someone clearing your market, like Citibank, JP, or someone else. So we are trying to amend the laws accordingly, trying to upgrade our jurisdiction accordingly so that they can find it as a investable and compliance with well enough compliance so that they can clear your market. And hence, due to recent geopolitical shifts, we have all witnessed lots of compliance issues because Armenia is positioned between the east and the west, north and south, and due to the Ukraine war, lots of new sanctions. And Armenia is also at the same time part of Eurasian Economic Union. So you need to find a way to navigate through all these compliance challenges as well. And the only way is to pay to the best law firms based in US, in EU and in UK to give you legal opinion, to shape for you compliance framework so that you can become kind of an eligible counterparty for foreign investors. But we also started to look at the south, but to Middle East, where we sit right now, and we signed an agreement with Abu Dhabi Stock Exchange to join the Tabadul Hub, which our colleague from Oman Stock Exchange, Mr. Raitam, has already joined, so that we can become a part of the larger network, so that we can act as an integrator between the Middle East and the EU, because parallel to that, we have also started the integration project with the Warsaw Stock Exchange, so that we can cross-trade, our brokers can cross-trade with Warsaw and Armenia, and hence joining the Adabadul will enable us to cross-trade Armenia, Middle East, and maybe in the future EU with the Middle East through us. But again, there are lots of challenges: regulatory, compliance, risk, capital, etc., which can be solved. There are costs. You have to pay a good lump sum money upfront for technology, for the legal advisors, and for business development. It will take 5 years, but you will reach to that point. Thank you.
Thank you very much, Mr. Iganian, for your points. So now let's go to the next question. which is what are the key challenges and lessons that have been encountered by frontier markets in their efforts to upgrade their markets. And we would be more than happy to listen the remarks from Mr. Haytham Al-Salmi, CEO of Muscat Stock Exchange.
Thank you, Arfan. It's good to mention first that Oman Muscat Stock Exchange has started as a private company since 2021. And prior to that, it was a government unit, a government exchange under the umbrella of the regulator directly. And it was established in 1989. So we are 35 years old exchange, let's say 36 years now, and almost 4 years as a private entity. So being private, we have skin on the game now. We understand that our sustainability is all about pleasing our stakeholders, including issuers and investors. And to do so, we need to make sure that we create good volumes, good activity in the market, good market cap. So for us to create good revenue to sustain and upgrade. So we thought the best way is to increase visibility of the market, increase attractiveness of the market by having the first 5-year strategy. The strategy has the core of that strategy is to upgrade the market to emerging markets. We understand our path toward upgrading the market is the way toward achieving a lot of tick boxes that we need to do in our market. First of all, market cap increase. So we are on the way to emerging status. If we talk about liquidity and liquidity boosters, then it's the path toward market upgrade. If we're talking about products and how diversified is the type of the companies, how reflection we can put in our indices toward the economy of Oman is the path toward the emerging markets. So we thought putting the core of the strategy as the ultimate reward is upgrading the market will put us on the right track. It's good to mention that once upon a while, the Oman market was one of the largest in the GCC. And because of the different sizes in the economies of the GCC, we have our neighbors from Saudi, the largest economy in the region. We cannot really compete using the traditional way of businesses. So my role, being now as a private exchange, first of all, to capture what we have missed comparing to the GCC markets. There are 7 GCC markets, 5 of them are already upgraded to emerging status, and we are behind ourselves with Bahrain. When we talk about the performance of our companies, we have one of the highest dividend yield payment in the region. Currently, the largest company listed in the exchange gives more than 10% annual dividend yield, which is very high comparing to the region. So what we are missing actually is the activity. So putting that, we work closely with MSCI and FTSE to understand their requirement, their calculation of free float, their calculation of market cap and ATVR, the average traded volumes. And we found that the most challenging situation that we are facing is totally different than GCC. We are an open market from day one. From 1989, our market is open for foreigners. Our market was following the best practices. In 1998, we have separated the regulator from the market from the CSD and clearing house. So we are following the best models. We are doing our assessment with Thomas Murray in terms of our CSD rating. We are following the BFMI requirements. So all what is required from investors, international investors, is already there met. But we miss liquidity, we miss market cap, which is most challenging situation because you cannot really handle it in the exchange level. Market cap, the size of your companies, is out of your control. So to have big companies that fits MSCI and FTSE requirement is a massive challenge, and it's totally out of our control. where we see the recent development that happened in Kuwait and Saudi. Their situation was totally opposite. They have large cap companies, they have volumes, they have huge economies. What they missed was the regulatory framework that support the requirement of MSCI. The 22 standards or criteria that global indices has put to create the upgrade, out of them 9 has to be satisfied to be classified as emerging, was their challenge. For us, we have ticked almost 15 out of the 22 long time ago. So we don't miss any technical requirement. What we miss is market cap. So that's put us in a different situation where we need to work closely with the government. We are an oil producing country, and most of the big companies are under the umbrella of the government, the state-owned entities. So we need to work closely with our stakeholders, the government mainly, to convince them of our story, our targets, and how that will bring FDIs. The good story that we have Oman Vision 2040 that has 3 main objectives that really fits us. The first one is to diversify the economy, and that means that we need to go out of the legacy of the oil and bring new revenue streams to the country. So that happens by moving out, and that means divestment. The government will have to divest their state-owned entities, especially in the oil sector, and go into new ventures. Going into new ventures will open doors for partners. Partners, that comes with the second objective, which is partnership with the private sector. And it happens in the capital market mainly because that's the right venue to create partnership. And the third objective is FDIs. FDIs, they want resilient market, they want a secure place, and there's capital market comes to the picture where they want to register their ownership. They can put a proper custodianship in their investments, and capital markets are the right venue. So we counted in those 3 main objectives of Oman Vision 2040, and we work closely with the government to convince them that we are the right venue for their way and path toward those 3 objectives. And it happens, they have a clear divestment plan, and we had the largest IPO ever, not just in Oman, in the whole GCC, which is OQEP, the exploration and production of oil. It was with a value of $8 billion market cap. Out of that, 25% was floated. We had a good series of IPOs, and 30 companies has been announced as a potential divestment of the government. So the challenge here was market cap and liquidity rather than market infrastructure itself.
Thank you very much, Mr. Isam, for valuable remarks. Thanks a lot. So we will continue with the same question about the challenges and lessons that have been encountered by frontier markets. And we would like to ask Mr. Jalal Tarif, Secretary General at Union of Arab Security Authorities.
Thank you. I think we can't ignore what's going on in the markets. It's been a very hard time in the last couple of days. And this is one of the major challenges that markets is really facing, is how to deal with the market volatility. And this is not only in the mature market like the United States or in Europe, but for the emerging market. Most of our market is really affected by what's going on in the trade war and the advanced economies. And it affected the frontier and emerging market hardly. So facing volatility and market changes and risk is one of the major challenges that frontier market as well is facing. And we have a good experience with the previous crisis like COVID and the geopolitical crisis. And the market have introduced very important tools of dealing with the volatility of the market. So I believe that this is a challenge, and we should understand and learn how to react to such crisis, which is something I think we should consider. This is one of the most important things happening now. On the other side, when we look to the other major challenges, I believe the legal framework and the regulatory framework and the institutional stand of the capital market is a major challenge. I believe we still have, when we talk about frontier markets, we still have weaknesses in the regulatory framework and in the institutions itself. We lack the independence of regulators, which is very important. Regulators should be independent and be able to act independently to oversee the market. This is one of the most important issues that, from the regulatory perspective, institution itself, I think we still also have weaknesses in many of capital market stakeholders, especially when we talk about market infrastructure, when we talk about clearing systems, trading system. We still have weaknesses in many of jurisdictions in the frontier markets. The other issue which I would also like to touch upon is the governance, which is part of your other questions. I think this is one of the challenges now frontiers market are facing, the implementation and of the international standards, of international sustainability standards. It is very important for the frontier market to really learn how to implement the guidelines provided by international institutions and the challenges in this perspectives. I think we have a long way to go, especially when we talk about greenwashing, when we talk about transparency, disclosure about sustainability. The third challenge, which I also think is very important, is the market depth and market volatility. I think the frontier market, they face problems with market depth. We have very low free float in the markets. We have shareholder base is really very, very narrow. The size of the market is very small. So when we are trying to find out a way of upgrading the markets into an emerging market or so, I think all these problems arise. And in order to do so and to make really real reforms in the frontier market, I think you have to consider what I have said before. It's very important. And to start the reforms in a way that make sure that you enhance the liquidity, the free float, the investors base. And finally, in terms of technology, I think there is a gap between the development and the advancement of technology in the capital market in terms of the industry and the capital market institutions. There is a gap, and there is a lot of work in terms of learning how to understand the changes in technology and how to enhance and use the technology to serve the capital market institutions, including the stock exchanges, the regulators, and market oversee. All this is very important. For the lessons, I think what we need is to start the reform, and it should be gradual. We cannot take it as a one decision. It will be gradual, and it should be phased out in a way that can the market absorb, and all market participants should be part of it. You cannot impose reform. Reform should be something evolved in the market. The second thing, I think it's how we can really deal with the government intervention. I think government should, in a way or another, stop intervention in the capital market. We need to have independent regulators. We need to have stock exchanges that really react according to the market. And even when you look at the many of exchanges that already privatized, many of them still owned by the government. So we need to phase out the government ownership and intervention in the market. I think I will stop here, and if there is any question, I will take it further.
Thank you very much, Mr. Jail, for your remarks. Highly appreciated. So now we go to the next question, which is about studying the impact of the deregulation. So we would like to know what are the effects of the deregulation on stock exchange operation and stability. And we would be more than happy to hear Ms. Ivana Gazik's remarks, who is president and the management board at Zagreb Stock Exchange. Yes, please.
Hello, thank you very much for the question. So, Croatia is the last country that has entered European Union, and we are also owners of one more stock exchange in Europe, which is Slovenian. And I have to say that this experience, being in the EU, operating two regulated markets, but under such different circumstances, actually is showing that the Europe didn't really do a good job in harmonizing the regulation between the markets. We are also closely collaborating with other countries in Europe. Some of the representatives are now hitting here with me. Peter from Czech Republic is also there, and we are often discussing how capital market union, that is now 10 years old, was an excellent idea. However, it wasn't successfully put into practice. And now again, European Union is starting investments and savings union, which should, from one hand, solve the problem of the older population savings, and on the other hand, providing resources for the growth of European companies, especially in the driving and fast-growing sectors like IT, artificial intelligence, cybersecurity, and so on. So basically, everything in Europe was around the regulation in the last 2 decades, probably. However, we can now see a very strong shift from the European Commission insisting on the local regulators to basically deregulate and enable stock exchanges to be more flexible. I think one of the main reasons for that is that big parts of financial system, like for instance cryptocurrencies, were not regulated for a long time in Europe. And this caused, I would say, competition between these two asset classes, which was not fair. Also, a number of European citizens have actually bought the stocks on US market because it was much easier to access there through the applications and fintech wonders that are out there on the market. So basically, as we speak now, Europeans are losing a lot of money on the US market because there was a huge trend of outflow of European market to the US, all because of overregulation, besides other things. So basically, I think that deregulation will increase the attractiveness of European markets. It will encourage more issuers to tap the market and raise the equity on the stock exchanges. And I think the potential influence on the stability will not be negative, because until now, the huge pressure of regulation has unfortunately done more damage to the markets than the benefits. And I don't think that automatically deregulation will bring chaos into the markets. Let's not forget that the biggest crisis, the last one, actually started in US and spill over to the whole world, and not even the regulation was able to stop it. So I really think that the markets should be more open and more liberal, and then it will enable in my region, Europeans to trade more cross-border, and all over the world, other capital to come to Europe, or European capital to come to other countries more easily and with less expenses.
Thank you very much, Ms. Ivana, for important points on advantages of the deregulations. We will continue with the same question from Mr. Petr Koplik, CEO of the Prague Stock Exchange, and we would like to know your opinion on what are the key effects of the regulation on the stock exchange's operation and stability. Yes, please.
Thank you very much. We are here, strange time, isn't it? We are amid of one of the strongest financial crises in the last 50 or 70 years. It's not caused by regulation, actually, but by stupid political decision. The crisis in 1930 was very bad regulation. 1987, regulation. 2008, 2009, weak regulation of the CDOs. And now it was delivered, although the regulation is still working pretty well. So it's funny to speak about the regulation in this very moment. I have to say, last week I was making part of the closing bell on the New York Stock Exchange on last Tuesday, while in 30 minutes the Armageddon started. So it was quite an inspiring situation. Okay, I'm not completely against the regulation, or I'm not completely for the regulation. A regulation should be clever. We definitely see the need for regulation, specifically in the areas of risk management for financial institutions. The worst situation you can get is a spillover effect when you have one institution running in deep troubles and spilling that over to the other areas. That is usually, these domino effects are disastrous, and history proved that some of the regulation is written correctly. If you look at the EMIR regulation, for example, in European Union, that withstand the Lehman Brothers fail. There was a position of multi-trillion dollars on this very Friday of Lehman Brothers in LCH ClearNet, and they were able to open on Monday without heavy losses, so the EMIR proved to be right. So there are definitely some good things, and we have to build the bricks on those things which are done correctly. And I would say specifically risk management have to be taken as a serious topic. I would say a little bit on the different side is the consumer protection. Ivana already spoke about that. We have tons of rules in Europe, and I would say even globally, which is preventing our investors to finance in the companies in neighboring countries, or in countries which are not neighboring but which are overseas. If you would like to invest in a plain vanilla securities or bonds in Europe, in some of the countries you have to fill in a questionnaire, which would be good for getting a master's degree in economics. While if you go out, you can risk your money with buying crazy real estate, buying crazy art, and even worse, buying crypto, which sometimes is compared to investment assets, which have no regulation whatsoever as concerns the consumer protection. So what we are saying, we have to see more level playing field. I think we have to see more investors in our countries, and it's not only for Europe, for all of our countries, investing in our IPOs and the growth of the economy and the debts of the companies we have, which help to create the wealth of the country. So the regulation have to be taken care of very carefully. And we have to differentiate between various parts of the regulation. There is a specific part of the regulation which now we see a lot of the drawbacks in that, which is ESG. I think we will speak about that later on in the panel. I think most of that gonna actually be cancelled or weakened. So this hype of this regulation is a bit over. There is, for example, for the European Union, we see a lot of the gold plating by the individual countries because in theory we are one economic area with a lot of the regulations valid theoretically in all of the countries, but then specific countries are making gold plating on the regulation, which is definitely very bad for integration of the market, and I think Ivana already spoke about it as well. So yeah, we see interesting developments. I would probably stress one thing: there is a DLT pilot regime in Europe for the CSDs. Prague Stock Exchange, which is part of the Wiener Börse, let's say, we have been able to receive first license and still the only license for the DLT evidence in Europe, DLT pilot regime. And I should not say so much loudly and officially, one of the main reasons why we are getting in this license is that it comes with the weaker regulation. So we were really using this window of opportunity to have a bit of weaker regulation if we are running the system on a different technology. The technology is not that great as a central database. The DLT is not that great technology. But if it's coming with a weaker regulation, why not to take the license? So those are the absurd effects of some of the regulations we see. But yeah, as a stock exchanges, so we are in general positive with the regulation or deregulation have to be done right.
Perfect. Thank you very much for very interesting discussion that we have on the deregulation, its advantage, disadvantage, and how it should be implemented. Very good. So I think now we can finalize the session 1 and we can go to the second session, which is going to concentrate on financial market integrity. So the session 2 will focus on the mechanisms that strengthen fair, transparent, and inclusive financial markets. Discussion will explore the role of technological advancement in enhancing cross-border trading and how innovation can improve market connectivity and efficiency. The session will also address how to ensure equitable market access for both emerging and developed markets, highlighting the strategies to reduce barriers and promote market accessibility. Participants will also examine ways to encourage listings through tools such as tax incentive, regulatory alignment, and targeted market support. Finally, the session will consider the integration and consolidation of stock exchanges, discussing its various forms, potential benefits, and associated challenges. So we will start with the first question, which would be, what role do technological advancements play in enhancing cross-border trading? And we would like to hear Mr. Dorji Funcho remarks, who is CEO and CEO of Royal Security Exchange of Bhutan. Thank you very much.
Thank you. Thank you, Irfan. Good afternoon to esteemed colleagues here. Well, it's an honor to be here to discuss on the changing landscape of our global financial market, in particular how we stock exchanges are trying to address issues related to market volatility, cross-border listing, manage risks. Over the years, if you look at how the financial market has evolved, I think things are changing in terms of, there are three things which is very prominent. One, the advancement of technology. I think this is a sole determinant which is changing, in a way, changing the landscape of how we do things. The second one is the rise in demand for sustainability linked as well as green financial products. And third, I guess it's we're emphasizing on inclusivity, which means we're looking at how can we facilitate cross-border investments. World is becoming flat. Cross borders are becoming invisible. So in that manner, if you look at the past, how technology has changed, we had come across from the noisy, chaotic trading pits to today. When you look at today, it is algorithm-driven, lightning speed trading. It has changed us. Increasingly, if you look back from what we have, the back-end process today, the trading strategies are driven by AI, big data, as well as we have machine learning, which is enhancing our capability in terms of predicting models, as well as assisting us in real-time decision making. When it comes to how technology is trying to enhance the cross-border trading, if you look at technology is not going to solve some of the issues related to cross-border listing. Issues like political will, your macroeconomic situation in terms of opening up your capital account, in terms of the economic stability. I think these are something which technology won't be able to solve. But when it comes to harmonization of regulations, we have seen few use cases of RegTech now, regulation technology, which is addressing a lot of issues on smart contracts. We see how cross-border payments system has changed in terms of Ripple coming in terms of you even have SWIFT, the last mile, which will automate the settlement process. We also see that when it comes to exchange rate risks, this is something which, again, we see the advancement in technology is going to, in a way, solve this. Increasingly, we are moving towards blockchain. We are moving towards tokenizing real world assets. We are moving towards using decentralized finance. So, in a way, this technology is going to change how we do things. It is going to change the very fabric of our financial system. So when we talk about cross-border, when we talk about, even I could, if I echo what our colleagues have said earlier, when it comes to clearing and settlement, it's a challenge. We have Euroclear, we have in the East, even Hong Kong Stock Exchange is trying to compete with Euroclear. But I guess technology is going to take us, it's going to leapfrog us in terms of harmonizing, in terms of giving access to all the exchanges. I won't be surprised one day if we have a uniform global platform where trading could take place, where our companies, our exchanges, the listed companies could raise funds as well as attract investment. I think it's not very far that we already saw how crypto exchanges, how digital exchanges have changed the way we raise funds, the way we make investments. I think it is going towards decentralized, it is going towards peer-to-peer. So it's a very exciting time, I see, in terms of the leapfrog that technology would bring in. I can also see that the global investment platform with CBDC in place would be something very interesting. There probably geographical boundaries may not mean anything. Today, a small company in Bhutan will have the ability to raise funds from somebody in New York, for that matter, somebody from Dubai, somebody from Oman, somebody from Belarus. I think technology is changing the very fabric of our financial system. But at the same time, we all have to be very cautious, particularly on the threats. The cybersecurity is an issue, but I guess this is something which systems are trying to rectify. And the forces of these changes are, in a way, evolving as well as forcing us to, take this step. And I won't be surprised that the things which the process which we are doing right now, involving the intermediaries, will be a distant past soon. In next decade, who knows, technology is going to be different. We won't be even bothered about, promoting cross-border listing, because then we will have a uniform platform. So I'll just skip to that. If there are questions, maybe later. Thank you.
Thank you very much, Mr. Dorji, for your remarks. So now we go to the next question, which is concentrating on the studying how we can ensure that the market access is equitable both for emerging and developed markets. And we would like to start with Mr. Hassan Dude, CEO of Somali Stock Exchange.
Bismillah. Thank you, Irfan. Firstly, I'd like to take this opportunity to thank the organizers for hosting such a wonderful event, Marwa and her team, and of course the chair, who's making sure that we all get together and have a proper discussion on these important topics. It was really good to see you all. I also appreciate the opportunity of meeting each and every one of you and sharing ideas and of course, sharing some thoughts about the capital markets. And I think it's one of those things that we take granted. We take for granted in terms of sharing ideas when you come to important events like this. Thank you. So the question I was asked is from session 2, capital market financial markets integrity. Integrity, yes. And the question is, how can we ensure that market access is equitable for both emerging and the developed markets? Now, to answer that, I would like to point out 4 key points that I think are worth mentioning on this particular topic. And I would start by saying that governments and businesses should make an effort in focusing on these 4 key areas. And the first one is building or improving trade economic relations between the 2 economies. And now that we're talking about connecting markets, I think that's very important to begin with, to build that trade or economic relations between the 2 countries, because without that, there will be no market connectivity. And an example I can think of would be countries like the United Kingdom and Morocco. I was fortunate enough to attend one of the events hosted by the Securities Exchange of Casablanca. And so what they did was something called Capital Markets Day, where they bring institutional investors and anybody that's particularly involved in capital markets together. And that way you can find, obviously, institutions and investors who are interested in these, in both economies. So I think that's a good way to start. That's my first point. And the second point is reducing trade barriers. Obviously, we see all these trade wars going on around the world currently. But what I'm talking about is reducing trade barriers in relation to capital markets. And what that means is making capital market accessibility by reducing restrictions. An example, reducing cross-listing costs, reducing brokerage rates for investors to trade cross-listed financial products, for example. So by making all these restrictions, restriction-free in those zones will definitely have an impact on improving connectivity. And the other point I'd like to mention is fostering inclusive policies that support small and medium-sized enterprises in emerging markets, because the fact of the matter is that in emerging markets, that's where you have most medium and small enterprises or companies listed on securities exchanges in emerging markets, if you like, in comparison to the developed economies. So having looser or friendly, I would say, supportive policies will definitely go a long way. And the last point is promoting capital market infrastructure development. And that, of course, technology is very important. My colleague has just talked a bit about that. So we need to have certain technologies that need to be shared so that the trading processes are smoother and have payment systems that lower transaction costs. This is something we're actually working on currently in East Africa. So for the ESA members, ESA is the East Africa Securities Exchanges Association in East Africa. So we have 8 stock exchanges from 8 countries and about 5 CSDs that are member of the ESA. And what we're doing now is we're building capital market infrastructure that allows new joining members and also the existing ones that have been in the group to easily trade and cross-list their financial securities products. So that's important. And the other important thing is improving employee knowledge and skills. Of course, when these systems are introduced, they need to be trained. The staff need to be trained on these systems and so on. And generally, improving skills of the employees in any, obviously, institution are eventually beneficial to everyone, really. And finally, that is to enhance financial literacy and investor awareness, particularly in the capital in the emerging markets, because we have low rates of, I would assume, low rates of financial literacy. For example, where I'm from, the last survey that's done was around 17%. Is improving a little bit now, up to like 20. Where in most developed economies, now I'm talking about both, obviously, emerging and developing economies, and now that we're talking about how we can connect these, how can we have that equitable market access, it's very important to look at the fundamentals, whether it is the investor knowledge or technologies, policies, all these things are important. That we look into those and sort these things out. So these are the points I wanted to simply highlight. So these are the key 4 areas I think we should focus on, whether we come in from governments or businesses. I thank you all, and if you have any questions, I'll be happy to answer, and I'll be around. Thank you.
Thank you very much, Mr. Hassan, for your valuable remarks. So we would like to continue the same discussion on how can we ensure that market access is equitable for both emerging and developed markets. And we would be more than happy to hear Mr. Bob Karina, Chairman of the Rwanda Stock Exchange. Please.
Thank you very much, Efan, and thank you all for being part of this and sharing our ideas as to various issues in the market. I will add on to what my colleague Hassan has said and say that to ensure that market access is equitable between emerging and developed markets, we need to consider a multifaceted approach and address things like barriers in the market, collaborations in the market, and sustainability. And look at key strategies like regulatory harmonization between the markets, capacity building, access to finance, inclusive trade barriers and policies, support for innovation and market intelligence and data sharing. When we look to regulatory harmonization, there is need to facilitate dialogue between the emerging markets and developed markets to harmonize the standards existing in those different markets and the regulations. This, if done, it can lower the trade barriers and products would move easily between those markets. Secondly, there is the capacity building, especially for the emerging markets, where this can be done through training to enhance the ability of the training programs to enhance the capacity of the local markets in the emerging markets, improving infrastructure, like Hassan has said, that needs to upgraded and the like, and access to technology, which, as it was mentioned earlier, it might take the world to a one market state. And then the access to finance. So we need to broaden the access to financial resources and things like give grants and low interest loans to those businesses which are not able to get finances, especially in the emerging market. And this will enable the local businesses to scale up their operations and engage more effectively in the international trade. Then when we look to inclusivity of trade policies, we should encourage the government and international organizations to implement trade policies and support inclusivity. This may involve preferential trade agreements and incentives that prioritize partnerships with business in emerging markets. Then we have support for innovation. We need to promote innovation in emerging markets by facilitating access to research and development resources, collaborative projects with developed markets, which can stimulate innovation and help bridge technology gaps. Finally, there is market intelligence and data sharing. We need to establish platforms for sharing market intelligence and industry insights to equip businesses in both emerging and developed markets with the information needed to make informed decisions. Transparency in data can also enhance trust and collaboration. So in summary, let me end by saying, achieving equitable market access requires a concerted effort from policymakers, businesses, and civil society to address existing inequalities, support capacity building, and promote sustainability practices. By working together, we can create an inclusive environment where both emerging and developed markets can thrive. Thank you very much.
Thank you very much, Mr. Bal, for your valuable and enlightening points. Very interesting. Thanks a lot. So we will continue with our next question, which is going to concentrate on stimulating the listings, both the cross-border and also the domestic listings. As we all know that in many markets, we are in cold period of IPOs, and we know that regulation might be helpful in order to solve these problems. So we would like to know what can be done to promote cross-border and domestic listings through different regulations that we can implement. For example, tax incentives, regulatory alignment, and targeted market support. And we would be more than happy to hear remarks from Mr. Lukas Bonko, CEO of Bratislava Stock Exchange.
Thank you for having me here. Shortly about Bratislava Stock Exchange, we are in the Central Europe, therefore we are member of the European Union and Eurozone. So we share also the common currency and common regulation with other stock exchanges within the EU. Regarding the promotion of cross-border and domestic listings, the first and very important question is what do you want to achieve? And as we are right now working together also with some of our colleagues who are now present on a cooperation in somehow integration of multiple markets and multiple stock exchanges within the EU, we've got a first-hand experience. And the answer for questions what we want to do is to increase the liquidity and simplify the access to our stock exchanges. Therefore, the issuers itself will have a higher liquidity pool, which translates in the future in better valuations and also the attractivity for local investors. Regarding answering the questions, what do you want to achieve? If you want to, for example, get a better classification of your market, so for example, getting from frontier to emerging in MSCI classification, then there is good questions about the harmonizations of the surrounding countries. Because within the classification of FTSE, MSCI world, they look on some specific criteria like what's the size of the market, how many companies about specific market cap do you actually have. And because for smaller countries this can be very difficult to achieve, then there is an opportunity to start with harmonization of the regulation, trading, listing rules, and in the future you can be treated as a single region. This was actually achieved within the EU in the Baltics countries, and now they are treated together as one region. Why to do it? Because you are enlarging the pool of capital which is actually available to your market, because you will be in the indexes, for example, emerging or developed, not just frontier, and the pool of capital is therefore larger. And as the passive investment strategies are currently the most common one, you will get probably better funds from the ETFs and mutual funds which are basically following benchmarks. But if we go into the details, as this was a very general one, if you want to promote a local, not just cross-border growth of the listings, which can be IPO or direct placement, tax incentives are usually very important, but not just tax incentives on the side of the investors, which is usually capital gains tax, but it is considerable also to introduce corporate income tax in a lower level. Why? Especially this is critical in countries as in EU, the regulation is quite challenging for the companies. So also my advice is when your government start to look for inspiration in the EU, as already was said by Ivana and Peter, you should be very cautious. There are very negative and both positive inspirations, and what is important is the transparency, but not to over-regulate your markets. So you should aim for tax incentives as the lower corporate income tax. Other thing which should be there is capital gains tax, which should be zero after some holding period. That's very important to boost also the investors' base. Regulatory alignment, and I think what is important to have some common international rules like the international financial reporting standards, maybe integrated reporting, if you are aiming for some like additional information for the investors. But I would be very cautious about ESG standards, which are now in EU, and now they are being reconsidered. So I would be very cautious. For smaller market, what is particularly important is to have liquidity support. For example, market makers, which can be supported also by the government or some financial institutions, or you can also have a look for the International Development Bank if they can support this. And what is very important is to have the primary market developed. So IPO funds usually can be very helpful in developing the primary market, as because stock exchanges, we are just the infrastructure which allows to join the demand and supply of capital and investments. About technology integration and a larger scale of cooperation, this again the question is what you want to achieve. In our case, what we are trying to achieve is to have a harmonized market, so a larger liquidity pool. And maybe in the future, if you start to think about how you should operate, you can share some best practices, share some technology, as economies of scale is very important. So basically, these are the key topics. And thank you. That's all from my side.
Thank you very much, Mr. Lucas, for your valuable points. Building upon Mr. Lucas' points, we would like to know Mr. Ruslan Khailov, CEO of Baku Stock Exchange, points on how we can stimulate the listings through the different incentives, such as tax incentives, regulatory alignment, and targeted market support.
Well, thank you very much, Irfan. It's indeed a pleasure to attend this roundtable of discussion, and I think most of the topics being discussed here are interrelated, so I'll probably touch some of the topics that were previously raised by addressing this question. Well, a little bit about Baku Stock Exchange. It's the only stock exchange in Azerbaijan, and Azerbaijan is a former Soviet Union country that's now very much energy-driven in the GDP composition and exporting oil, and the local capital market is primarily government and sovereign bonds in a dominated market. So as a stock exchange, one of our main strategic initiatives is to boost or to uplift the listings in the Baku Stock Exchange. Even though the market cap to GDP penetration ratio is around 5% right now, it is targeted to be increased by fourfold, I would say. And starting with the domestic incentives and regulatory, alignment measures, I think most of the things that Lucas was talking before me about tax incentives, about the incentives, about the tax discounts granted on the interest income earned on the bonds or dividend income earned on the stocks, and even to some extent capital gains tax, discounts. All those measures are being implemented in Azerbaijan already like 4 or 5 years. And the regulatory, application, the registration of the stock issuance or the listing in Baku Stock Exchange or through the regulatory body, the Central Bank of Azerbaijan, is very much softened right now. I couldn't imagine even lower standards probably, for the corporate issuers or retail investors to come to the capital markets. But the question is, did those measures really address the targeted, focus? Did we get the expected uplift in the number of listings in the stock exchange or in the volume of the trading in the stock exchange? And obviously, the answer is no. And I think the fundamental reason for that is that I believe many regional countries, not only Azerbaijan, for example, we have good connections with Bursa, Istanbul, with Kazakhstan, with other regional countries. I think most of these countries are primarily banking sector dependent in the construction of the financial system, and even the participants or potential participants of the capital markets, they do not really understand the composition and incentives that are presented in the capital markets to them, so they can come to the capital markets and generate the listings and the volume. So whatever measures we don't take, I mean, whatever regulatory softness or tax incentives we don't apply, those would be just, generating artificial results rather than fundamental results. And the fundamental results should be generated by cultivating the financial system itself to shift even to some percentage to the capital markets usage, right? And that layer of the capital market cultivation should come from the institutional layer. I mean, the private pension funds, I mean, asset management companies, institutional wealth managers, and investment banks, which are very less developed compared to the developed markets in emerging and frontier markets. And the practices in emerging and frontier markets could be at most like, some investment bank headquartered in the developed world, but opening its rep office and selling the original services in the frontier market. But it does not cultivate the practice of the institutional investor layer. And what we usually hear from the domestic institutional, market players is that the regulatory requirements and the capital requirements or the KYC AML to bring their clients to the market or to advise to a particular corporate structure to raise any financing in the market is very harsh, and they cannot simply comply with that. What they choose is rather to go and invest in the bond market and the sovereign sector and just make money out of that. And when we say why a regulator is putting so much, harsh requirements, it's like a regulator relates this to international standard setting bodies, and that, okay, the international standard setter is applying the globally applicable unique standards for regulating banks in capital, in services extended, etc. So I think one of the problem now, if we come to cross-listing, comes from international, standard setters, that the standards sometimes, pushed forward and the regulatory measures are not accounted for the local practicalities of the frontier markets. And I heard this, comments even from some Southeast Asian, countries. So, to put it in a nutshell, I think to really boost the listing, the regulatory alignment and tax incentives and the targeted market support should be extended to cultivate conceptually, institutional layer of the capital market constitution. The facilitators of the common, wealth management and the facilitators of the fundraising in the market. And that should be very much aligned and communicated by the local regulatory authorities with the international standard setters in order to harmonize the same principles along the cross listings and dual listings. Thank you very much.
Thank you very much for your valuable remarks. So we will continue with the next question, which concentrates on benefits and drawbacks associated with the stock exchange consolidation or integration. So we would like to know what are the forms, benefits, and drawbacks associated with the integration of the stock exchange, especially in Southeast Europe. And we would like to hear remarks from Mr. Ivan Shteriev, CEO of Macedonian Stock Exchange. Yes.
Thank you, Erfan. Good afternoon to everybody. As Erfan explained, I'm coming from Republic of North Macedonia, formerly Republic of Macedonia, Southeast Europe. So actually, quite small geographical area with many actually sovereign countries slash stock markets. So we are speaking about the area with around dozen stock markets, and most of them, besides Athens Stock Exchange from Greece, were actually recreated in early 90s after the fall of socialism. And at the very beginning, creating of the stock exchanges in that region was, let's say, perceived as very optimistically, knowing or believing that with the complete transformation of that centrally planned economies, the stock exchanges will start to function quite soon as in the developed markets, which was not the case because definitely these countries and these economies actually had some other development path. So in the 90s, stock exchanges were serving more or less for the privatization purposes. Afterwards, some kind of consolidation of ownership after privatization was done through these stock exchanges. And then, and I'm not talking about early 2000s, we realized that the stock exchange business, the capital market is business of scale, that size matters very much. And then we started these discussions about consolidating the regional stock markets, integrating, etc., etc. At the very beginning, again, it was with quite big optimism that we will find a mechanism to do that, especially because we are speaking more or less of not big, for example, cultural barriers, language barriers. So at the beginning, it was optimistic that we will find a way how to consolidate the markets. And then these classical questions arise in the discussion. What does it actually integration mean? Whether we will have one market or more market? What will be the solution for personal issues? Because if you are creating some one entity, then all these managerial issues are important. Then how we will split the revenues according to the domicility of the listed companies or domicility of the investors. So the conclusion was that it was very easy to go with full integration. Then we started to speak about cooperation and immediately realized that there are two areas in which cooperation is very easy, useful. That is sharing of knowledge, know-how, of course, and especially some projects, joint projects in the area of promotion, PR, like joint roadshows. So in the marketing promotion area, it's very easy to cooperate between stock exchanges because you are sharing the costs and sharing the benefits. But this is not integration. Then integration due to different circumstances, not only in the region. Two models of integration were, let's say, on the table. One was, let's put it like a strong form of integration connected with ownership consolidation as well. And the second form is a more soft integration. So in that period, it's again late 2000s, some other stock exchanges, bigger players, started to acquire some ownership stakes in exchanges in the region, Borsa Istanbul, Vienna Stock Exchange, Greece, Athens Stock Exchange, and in some of the exchanges there was a new, let's say, optimism that with these bigger players going into ownership structure will actually facilitate, contribute for increase of the turnover, more foreign investors, etc. Then it was realized that this is useful. Again, you have even better exchange of know-how. You are not having these confidentiality problems because you are the same group. But again, the mere fact that you will have ownership, some bigger market as owner of a smaller market is not creating increase in the order flow, new investors. The quality of the companies is the same. The perception of the investors about the quality of legislation, enforcement, it is the same. So it's not solving the issue by itself that you have foreign ownership from some good developed stock exchange. And then The second form of integration was discussed. I mentioned it like a soft form of integration, trying to use the technology in order somehow to connect the market, either trading systems itself, either brokerage back office system, so something similar with this current Tabadil project. So 3 exchanges, actually, Zagreb Stock Exchange, Ivan is here with us, and Bulgarian Stock Exchange, together with Macedonian Stock Exchange, we created a special order routing platform called C-Link, Southeast European Link. We were also supported by European Bank for Reconstruction of Development, and we actually developed special software application who is connecting the back office systems of our members. Also, we were pumping free market data into that platform. Additional 4 exchanges joined, and at the peak of that attempt, we were 7 exchanges in the group. However, the brokers and investors who before for years were actually asking from us to deliver some kind of solution for connectivity and integration of the market were not very, let's say, proactive in promoting and selling this platform and possibility to trade quite easily within the region, and some sporadic trades. So it was not big success, but we have some lessons learned after that. It is very important to have really financial intermediaries on board with this kind of soft integration projects, because they have to sell, to promote, and to their clients to trade within one geographical area. So the second lesson is that one should be quite cautious in assessing whether there is a real interest for trading cross-border within some smaller geographical area, because you always have this competition from developed markets. So our experience is that local regional brokers were more fond to promote investment opportunities in developed markets, not within our area. And the third lesson is that, of course, post-trading is very important. We deliberately let it to be second phase of our project, because if we started with post-trade, probably we wouldn't achieve even this result. So our central securities depositories in the region, some of them were not very reluctant to cooperate. So this is our story, our forms of integration in our region, our lessons and drawbacks. We are still believing that this is something which is very important. There are now some new initiatives, again, supported by EBRD, with some different type of geography, which means that the likelihood of success is quite higher. And also, and with this I will conclude, some of the projects in this area probably should be repeated after some period of time, because maybe in some cases, in some endeavors, you're trying to do something before the whole environment is mature enough to accept this kind of initiatives. Thank you.
Thank you very much, Mr. Ivan, for your points on the consolidation and integration of the stock exchanges. So I think now it's a good time that we conclude the second session, which concentrated on financial market integrity, and we can start the third session, which focused on the role of stock exchanges in promoting sustainable finance and ESG integration. So session 3 will examine the evolving role of stock exchanges in advancing environmental, social, and governance standards. The discussion will focus on the key challenges exchanges face in implementing ESG frameworks. Participants will also explore how exchanges can effectively encourage listed companies to adopt ESG practices without imposing overly burdensome regulation, striking a balance between promoting sustainability and maintaining the market competitiveness. The session aims to highlight practical approaches and collaborative strategies to support ESG integration across diverse market contexts. So we would like to start with the first question, and that is, what are the biggest challenges faced by stock exchanges in implementing ESG standards? And we would like to start with Mr. Fadi Kanso, Deputy Secretary General at Arab Federation of Capital Markets.
Thank you, Arfan. It's truly an honor today to be here and to share insights with such distinguished speakers. And I'm grateful for this opportunity to contribute to this conversation, especially when it comes to sustainability and promoting ESG. So we all know that ESG awareness is growing globally. However, implementing ESG standards in stock exchanges presents several challenges. So I'm going today to implement and to identify, let's say, 12 challenges that we are facing. And at the end, I'm going to share a few insights and data about the Arab region in specific and the progress achieved by Arab stock exchanges over the last 5 years. So I will start with the first challenge, which is the lack of unified regulations and standards. We all know that different countries and different regions have varying regulations, and unfortunately there is no unified ESG framework across many regions, especially in the Arab regions, for example. So this creates, for example, some confusion, inconsistencies, what makes harder for businesses to comply with ESG standards in a standardized manner. Two, we have some cultural and economic barriers. For example, some companies and investors may be more focused on short-term profits rather than long-term impact of sustainability on financial performance, which can make them less inclined to adopt ESG principles that might initially seem to conflict with immediate financial gains. Adding to this, many countries in the world, especially those dependent on oil and gas or on construction, real estate, industrial activities, face some challenges in shifting towards more sustainable activities. While economic structure in some countries is often based on sectors that may not align naturally with ESG goals, which could pose a dilemma somewhere in adopting more sustainable practices. Three, the data availability and transparency. ESG reporting, in fact, is heavily reliant on data. But many companies, mainly in the Arab world, for example, lack comprehensive ESG data collection systems or do not disclose such information in a standardized manner. So even when companies do report ESG data, there's often a lack of inconsistency in how they present the information, what makes it difficult for investors to compare performance across companies or even regions. Four, insufficient ESG investment instruments. Several regions in the world still have relatively few ESG relative, for example, financial institutions such as green bonds, ESG-focused traded funds, ETFs, which could limit, for example, the investment in companies that comply with ESG standards. Five, we have the resistance from traditional sectors. As I have mentioned, we have many regions in the world who are heavily dependent on oil and gas, construction, industrial sectors, which can sometimes be at odds with environmental sustainability goals. That creates, in fact, some resilience or some resistance among some of the most influential companies across the world. Six, we have some political and institutional challenges. Some countries face challenges, for example, related to weak governance structures and some lack of transparency. This could complicate, in fact, the implementation of ESG standards, as companies may be unwilling to or unable to meet, for example, ESG reporting standards due to some institutional limitations. Not to mention, some countries have some ongoing political instability in some parts of the world, maybe in the region, which could create some uncertainty and could hinder, for some instance, the progress toward implementing ESG standards. Seven, infrastructure and technological gaps. Many stock exchanges, for example, and companies may lack this technological advancement or infrastructure needed to collect or analyze the ESG data. 8, we have a lack of enforcement mechanisms. When ESG standards are implemented, enforcement may be weak, with limited penalties for non-compliance. This can result in companies only paying, let's say, some lip service to ESG principles without truly integrating them into their initiatives. 9, we have a lack of incentives for companies to adopt ESG practices. In many parts of the world, I'm talking about the Arab region, for example, companies do not have strong financial or tax incentives to adopt ESG initiatives. The absence of green bonds, for example, or sustainable investment funds may discourage firms from actively pursuing ESG goals. 10, challenges in implementing ESG into traditional investment and financial systems. So the integration of ESG factors into financial valuation models is still in its early stages in some parts of the world. Traditional financial systems tend to rely mainly on conventional financial markets, like profit margins, earning sharing, market share, etc. 11, we have the role of sovereign wealth funds and state-owned entities, mainly in the Arab world, for example. They have significant influence on global investment, this is what we know, and they are increasingly expected to incorporate ESG in their activities. However, integrating ESG factors into the investment policies of such funds could be challenging due to their large-scale investments, and they are more or less focused on activities that are not environmental friendly. 12, the greenwashing concerns. This is across the world. Unfortunately, companies present sometimes themselves as more environmentally friendly or socially responsible than they are in reality. This is a major risk for stock exchanges. Now, what I can say, allow me to share a few data for the Arab region. The Arab Federation of Capital Markets is the Arab industry of 18 Arab stock exchanges. Has issued by end 2020 a report on ESG guidelines where we have tried to discuss the ESG regulations, disclosures, reporting, etc. And then we have updated this report 3 or 4 years later just to check the progress achieved by the exchanges. What I can say that among 16 Arab exchanges that were surveyed and who are members at the AFCM, we have 11 Arab exchanges who issue written guidance on ESG, 11 out of 16. We have 9 exchanges out of 16 who offer ESG-related training programs, and we have 8 exchanges who publish annual sustainability reports. However, we still have 5 exchanges only who have mandatory ESG reporting as a listing rule. So what we can say that there was a progress, an improvement in the Arab world over the last 5 years. It is moderate to some extent. However, the level of awareness of the concept of sustainability in the Arab world could be said, let's say, good for the moment. However, further efforts are still needed to be exerted in some Arab markets, as many companies in the Arab world need to address increasingly ESG factors into their business models to improve their ratings. Because unfortunately some companies are still lagging behind their peers in the world regarding ESG ranking. So what I can say here that the Arab Federation of Capital Markets will spare no effort to promote ESG and sustainability among their members. Thank you.
Thank you very much, Mr. Fadi, for your valuable insight. So we will continue with the same discussion on the biggest challenges faced by stock exchanges in implementing ESG standards. And we would be more than happy to hear Mr. Miguel Monteiro's point, who is Chairman and CEO of Cabo Verde Stock Exchange. And I would appreciate if you can share his slide as well. Thank you very much.
Good afternoon, all. It's a pleasure to be here, Erfan. I will be strict to some key points because I have a second question that I would like to present. Meaning the implementation of ESG standards presents significant challenges for stock exchange, especially in emerging markets such as Cabo Verde. For those who don't know, Cabo Verde is a small island country in West Africa. Among the main obstacles are the lack of standardized regulation, limitation in ESG data disclosure and quality, low awareness among market participants, scarce resources for capacity building, and the risks of greenwashing, which compromise the credibility of information. Additionally, limit access to sustainable finance instruments delays the adoption of ESG practices. The absence of a uniform regulatory framework makes it difficult to establish consistent requirements for ESG information disclosure, particularly affecting SMEs, which often lack the necessary resources to meet these demands. Furthermore, the perception that ESG compliance represents an additional cost rather than a value-enhancing factor reduces companies' willingness to adopt such practices. To overcome these challenges, stock exchanges can and should adopt ESG guidelines aligned with international standards, such as the voluntary principles for sustainable bond issuance developed by the ICMA, International Capital Markets Association, and promote initiatives that encourage the use of capital markets as a tool to foster sustainability. It is also crucial to provide training for listed companies, strengthen market infrastructure to support sustainable financial products, and implement monitoring mechanisms to prevent greenwashing. In the specific case of Cabo Verde, in addition to adopting international guidelines, we have developed and reinforced the country's commitment to sustainability, notably through the Blue Taxonomy, one of the first in the world that was developed on 2022 in a partnership between the Cabo Verde Stock Exchange and the Technical University of the Atlantic, with the strategic support of UNDP and the Luxembourg Green Exchange. Furthermore, 3 regulations were created for the issuance of sustainable bonds, blue bonds, green bonds, and social bonds, strengthening the country's position in promoting sustainable finance through the capital market. In the second question, I will talk a little bit about the results of these efforts. Thank you, Erfan.
Thank you very much, Mr. Miguel, for your points. So we will continue with the second question, which is going to be how can exchanges can encourage companies to adopt ESG framework without imposing burdensome regulations? And we would be more than happy to hear Ms. Maria Ariza's point, who is CEO of Viva Mexico. Time's yours.
Hi, everyone. It's a pleasure to be here. Thank you for the invitation. So I know I'm the last one, so I'm going to be quite quick for everybody's purpose. So I know that not in all the countries ESG is still, well, it's compulsory. For us in Mexico, on 2026, Mexican companies listed in the exchange will have to comply with mandatory disclosure coming into effect just in January under IFRS S1 and S2. So this is going to be a huge change in Mexico's regulation coming very soon. So what we're doing, I think, it's trying to accompany all of our issuers so that this doesn't seem burdensome. So, more than a way, a transition, smooth transition for our exchange. So what we think we should do, it's basically more strategic in terms of education, in terms of financial products, and in terms of education that we can provide. So basically, right now, at Viva, we account for 76% of all of the issuings under ESG criteria. So we are leaders in Mexico. And I think we've done this basically with this strategy of making less burdensome for companies and be more a company in a sense of trying to comply with investors in Mexico in an easier and effective way. So basically what we do, first of all, it's, and this is some of the strategies we've put in place. We do a initial ESG diagnostic complementary scan for the companies to understand their ESG profile and construct this ESG strategy. So basically with that and in alliance with different specialized allies in ESG instruments, we help companies and assist them in necessary steps with rating agencies, with second-party opinions, ESG certifies, consultant law firms, and so on. So we work directly with issuers to structure, label, and sustainable linked bonds since the very beginning. To do that, we do a series of training programs. Basically, we train leaders behind the companies through two basically two training programs. One of them is we call it Chief Sustainability Officer. So this is a program that is being funded by the European Union, the IDB, and the IFC. And we train people from within companies, leaders from now more than 500 institutions around Mexico, equipping them with practical tools to integrate ESG into strategy and finance. And these professionals are transforming companies from within. Also, we have another program that we just put in practice this year, which is basically focused on these ISSB standards on Scope 3 emissions, exactly to prepare Mexican companies for complying IFRS S1 and S2. So we do this free of charge with funding from development banks and European Commission. So this is the way we help companies be ready for this transition and willing companies to access ESG bonds. Also, what we do is we created a technology platform to manage the company's ESG data. This basically allows a company to report and be transparent with investors, and it complies with standards, global standards such as SASB, IFRS, GRI, and PRI. So this helps companies report in a very efficient and way, and it helps also investors and auditors and analysts to follow up. And finally, what we do is we try to present companies with investors through conferences and Viva Days, as we call them, basically to attract investors from around the world, not only nationals, but also from Europe and Asia and other regions, so that basically our projects, our companies in Mexico are exposed to institutional investors. So I think basically what we do is trying to commit as an exchange for this transition more in in a help way, trying to educate, support, and accompany issuers along the way.
Perfect. Thank you very much, Ms. Marias, for valuable remarks. So we would like to hear also continuation of Mr. Miguel's points on the same question, which would be how can exchanges can encourage companies to adopt ESG framework without imposing burdensome regulations?
We see that it's essential to offer capacity building programs such as workshops and consultancy service to help companies, especially SMEs, to understand and implement ESG practices. And this is why the Cabo Verde Stock Exchange signed a memorandum of understanding with the Luxembourg Green Exchange to help us in mentoring and training all stakeholders. Also creating specific market segments for companies that meet sustainability criteria is also an important strategy to enhance their visibility. Market incentives such as reduced listing fees or financial benefits can encourage more companies to integrate the ESG practices while stimulating institutional investors to prioritize sustainable investments in increasing demand. To encourage companies to adopt ESG frameworks through sustainable bond issuance, the Cabo Verde Stock Exchange, in partnership with UNDP, developed the BlueX platform, which is a dedicated listing and trading online platform of sustainable bonds, including green, blue, and social bonds. The platform, which is intended to be regional, aims to help Cabo Verde diversify its financing sources, reduce dependence on external aid, promote entrepreneurship, and connect with key markets. Since its launch, BlueX has been successful in mobilizing capital for climate resilience and sustainable development projects, facilitating sustainable issuance between 2021 and 25, and attracting 182 investors. Many of those investors were from the Cape Verdean diaspora that invested on green bond, 20% of the total amount, and on a blue bond, 35% of the total amount. But to see that Cabo Verde sustainability is not a question of an option, but is something that is needed to be actually implemented. In January of this year, the World Bank launched the Country Climate and Development Report, CCDR, for Cabo Verde. This report is more than an academic exercise. It's a roadmap and a call to action. Cabo Verde must mobilize 842 million in climate investments by 2030 and 2.6 billion by 2050. This is obviously a substantial sum, but is also an opportunity to reshape our economic trajectory. The CCDR warns that if no intervention done, climate change could lead to GDP losses of up to 3.6 by 2050. For a nation like ours, a small nation, this is not just an economic statistic, but a direct threat to livelihoods, social stability, and long-term prosperity.
Perfect. Thank you very much for very interesting discussion that we have. I think now it would be a great time to close the session. And as closing remarks, again, as we conclude today's Head of Stock Exchanges Market Roundtable, I would like to extend my deepest gratitude to all our participants for their valuable contributions and insights. Throughout the session, we have addressed critical issues facing global financial market in 2025, from regulatory challenges to financial market integrity and sustainable finance. In session one, we discussed the evolving regulatory landscape, the challenges faced by stock exchanges in various jurisdictions, and the lessons learned from frontier markets. We also explored the effect of the regulation and potential steps to harmonize regulation across regions, ensuring that market stability and compliance efforts are upheld. Session 2 focused on promoting market integrity with discussions on the role of technological advancement in enhancing cross-border trading and ensuring equitable market access. We also explored strategies for encouraging listing through tax incentives, regulatory alignment, and market supports, and reflected on the integration of stock exchanges. In session 3, we turn our attention to sustainable finance and ESG integration, examining the challenges faced by stock exchanges in implementing ESG standards and how to encourage companies to adopt this framework without imposing burdensome regulation. The session highlighted the importance of finding a balance between sustainability and market competitiveness. In closing, the roundtable has generated a valuable insight that may lead to concrete policy recommendations for regulators and policymakers. Participants have identified innovative solutions and strategies for addressing market volatility, promoting sustainable growth, and enhancing the integrity of global financial market. This discussion will undoubtedly shape the path forward as we collectively work together for a more resilient, transparent, dynamic financial ecosystem. Once again, I thank all the distinguished members for their time and expertise. I look forward to the continued collaboration and progress we will make together. Thank you very much for your time.